Today, we are diving deep into a company that, by all accounts, just seems to defy financial gravity. Coca-Cola.
Right.
And, when people talk about these huge legacy brands, they usually focus on the marketing, the iconic images, the history, the taste.
Sure, the nostalgia.
But we are looking past the red and white can today, straight into the strategic recipe behind its financial longevity, its incredible durability. We are dissecting what makes KO a true financial machine.
And that machine has one key output that we're really focusing on today, and that's consistency. Specifically, its dividend history.
Exactly. Here's the mind-boggling statistic that really grounds this entire deep dive. Coca-Cola has increased its dividend for a staggering 63 straight years.
63 years. I mean, just stop and think about the economic landscapes that streak has survived.
Right.
You've got the oil crisis of the 70s, the dot-com bust, the great financial crisis, and the pandemic. That requires not just sales, but just radical financial discipline and continuous adaptation.
And that streak, as we know, earns the company the elite title of a Dividend King.
Mm-hmm.
For you, the listener, what that means is the company has raised its dividend for 50 or more consecutive years.
It's basically the Hall of Fame for financial consistency.
Yeah.
But we don't just want to state the definition, You want to emphasize how rare this is.
It's a very exclusive club.
Only 56 companies currently meet that qualification globally. It's a testament to sustained performance year in and year out.
That is an incredibly small number. So, okay, the mission for this deep dive is to understand the secret sauce.
The how.
The how. The strategic moves, often hidden from the public eye, that allowed this durability. And then we've got to assess its path toward reaching the truly rare milestone of 70 years of dividend increases.
A benchmark, by the way, that's currently achieved by only 3 other companies.
Only 3. So we're moving beyond syrup and bottles and really looking at how they engineered this perpetual growth mechanism.
I like that, a perpetual growth mechanism.
Okay, let's unpack this.
Let's do it.
Let's start with the foundation. What makes the demand for this company's products so durable and steadily rising?
Okay, so the foundation lies in 2 things: sheer scale and brilliant risk diversification. While we all picture that classic red can, the reality is that Coca-Cola owns about 200 distinct brands,
100.
which it sells across more than 200 countries and territories. That footprint provides immense stability because a slump in one region, it's often offset by a boom somewhere else.
That's global saturation.
It is, but what's really crucial is the concentration of power within that portfolio. Out of those 200 brands, 30 of them generate over $1 billion in annual sales.
$30 billion brands.
It's an elite club within their own portfolio, and that's what delivers the reliable cash flow.
Give us a few examples of what we're talking about there, because this shows they are so far beyond just carbonated sugar water.
Exactly. You're looking at stalwarts like Sprite and Fanta, of course. But also, the growth engines like Dasani Water, Gold Peak Tea, and Minute Maid juices.
Right.
This massive portfolio generates that robust, durable cash flow that's what pays the rising dividend and fuels the expansion. It insulates them from the consumer trend away from classic soda.
And how do they make sure that engine keeps accelerating year over year, especially when the core product is so mature? What are the mechanisms for that routine revenue increase, besides just hoping everyone drinks more soda?
Well, it boils down to 3 core organic growth drivers. You've got volume growth, just selling more units. You have routine price increases, and then consistently launching new products to capture new trends.
Okay, so volume, price, and new stuff.
But it's their operating structure that makes those price increases, let's say, stickier and more impactful than they would be for a competitor.
That makes sense. And they also invest heavily, correct? They're not just sitting on their laurels.
Absolutely. They pour money into marketing, productivity improvements, and continuous product innovation just to sustain those high organic growth rates.
And the proof is right there in the numbers.
It is. The result of all this, the consistent investment in the portfolio management, it's impressive. Over the past 5 years, Coca-Cola has delivered an average organic revenue growth rate of 9%.
9%. For a company of this age and size, that's a staggering metric. It shows they are absolutely finding ways to grow faster than global GDP. A 9% organic growth rate is phenomenal, but they're also masters of supplementing that internal expansion with, external fuel.
That's right. They routinely acquire new beverage products to quickly jump into high-growth segments.
Here's where it gets really interesting, because the data shows this strategy is highly effective. Since 2016, targeted acquisitions have driven a stunning quarter of their earnings per share growth.
A quarter.
We are talking about major deals like the purchases of Topo Chico and Body Armor that provided just immediate fuel.
Those acquisitions are strategic levers. Topo Chico, for example, it gives them instant credibility in the high-end sparkling water and mixer segment, which is, a world away from traditional soda. It's an immediate injection of trendiness.
But wait a minute, I have to challenge that for a second.
Go for it.
Topo Chico and even Body Armor, they're premium kind of niche products, right? Is relying on niche acquisitions for 25% of your growth sustainable long-term for a company this massive?
That's a great question, but the sustainability comes from the scale they apply after the acquisition. They don't rely on the niche products staying niche.
Oh, okay.
They take that trendy brand and they immediately plug it into their global distribution network, those 200 countries and territories we talked about. They turn a niche product into a global staple, and they do it fast, rapidly accelerating its profitability. That's the competitive advantage.
That accelerated expansion makes sense, but, even more critical than what they buy is how they finance it. Which brings us to, I think, the most important strategic maneuver of the last decade.
Let's talk about the strategic pivot. This is the move that structurally reinforced their entire balance sheet. It enabled that acquisition spree and, most importantly, it protected their sacred dividend streak.
We are talking about the major structural change of refranchising its bottling operations. Explain the significance of that, because for the listener, selling off bottling plants might sound like abandoning your core assets.
It was the absolute opposite of abandonment. It was streamlining. Over the past decade, Care systematically sold off its asset-heavy bottling businesses.
So getting rid of the factories.
Exactly. Before this, Coca-Cola was bogged down managing massive fixed costs. Think about it. Utility bills for huge plants, maintaining fleets of trucks, dealing with local unionized labor disputes, and constantly draining capital expenditure, CapEx, on new machinery.
So they essentially just shed the operational complexity in that massive capital drain.
Precisely. They moved from being a capital-intensive manufacturer and distributor to becoming a pure-play, high-margin brand, syrup, and concentrate company. All that operational headache was just offloaded to independent partners.
Okay, so what was the financial impact of offloading all those physical assets and operational burdens?
Well, it provided immediate and significant cash flow, and that cash flow was very strategically directed.
Where did it go?
Toward debt repayment, funding those strategic acquisitions we just discussed, and optimizing their shareholder returns through share repurchases. The end result is a balance sheet that is profoundly strengthened and streamlined.
And the financial health metrics, I assume, reflect that immediately.
They absolutely do. They maintain an elite A+A1 bond rating.
Which means?
What that means in practical terms is that when Coca-Cola needs to borrow money to fund a big acquisition, they can do it cheaper than virtually anyone else on the planet. And that is a massive competitive advantage.
That makes those acquisitions even more accretive to earnings.
Exactly. And furthermore, this refranchising strategy, it has driven their leverage ratio, their debt burden relative to earnings, down toward the low end of their 2 to 2.5 times target range. This low leverage is the core protection against a future recession and any market volatility.
It's their financial war chest. It gives them incredible optionality when other companies are, paralyzed by high debt.
And we can quantify that flexibility. Because of the success of this strategy and their low current debt burden, KO currently has the capacity to take on a staggering $12.6 billion of additional debt.
Wow.
Before it would even hit the high end of its own conservative target leverage ratio. That is an enormous amount of firepower, just reserved for the right opportunity.
Now that $12.6 billion figure is impressive, but I have to ask, doesn't maintaining that much capacity suggest they are being, too conservative? Are they sacrificing potential returns by keeping their debt load so low, especially when borrowing costs were historically cheap for so long?
That's the critical tension in the strategy, right? It looks conservative when the economy is strong, but their mandate isn't to maximize short-term returns.
It's to protect the streak.
It's to guarantee the dividend increase for the next 7, 10, 20 years, even through a severe downturn. That massive capacity ensures that if a recession hits, they can immediately borrow money cheaply and deploy capital to acquire distressed rivals, or double down on marketing when competitors are cutting costs. The flexibility is the long-term return maximization strategy.
That frames it perfectly. It's security over pure optimization. And we are already seeing recent massive transactions that prove they are committed to converting these non-core assets into financial strength.
Absolutely. Just look at two specific massive transactions in recent history. They agreed to sell their outstanding shares in the U.S. bottler Coca-Cola Consolidated,
Okay.
which resulted in a $2.4 billion cash infusion.
And internationally, they're executing a similar move, right? Selling a significant portion of their stake in the largest bottler in Africa.
They struck an agreement to sell 41.52% of their stake in Coca-Cola Beverage Africa. And this deal valued that massive African bottler at $3.4 billion. It just further reinforces their already elite balance sheet. These are calculated ongoing moves to convert fixed assets into cash to secure flexibility and future acquisitions. The balance sheet gets stronger every quarter.
The genius of the strategy is in prioritizing that financial health over the operational ownership of physical assets. So let's look forward. How does all this financial flexibility translate into hitting that 70-year dividend milestone?
It translates into focused, disciplined, high-growth investment. So despite shedding the burden of bottling CapEx, Coca-Cola still invests over $2 billion annually in capital expenditures.
So $2 billion.
And that's to support high-growth areas and the long-term model things like new product infrastructure and marketing technology. They are constantly tending the engine.
And what are they promising the market in terms of future growth? I mean, that 63-year streak relies on them hitting these numbers.
They have set very clear financial aims. They project 4 to 6% organic revenue growth annually. Crucially, they expect that growth, coupled with their financial discipline and shedding of low-margin costs, to translate into 7 to 9% annual earnings per share, or EPS, growth.
Pretty big jump from revenue to earnings growth.
It is, and that's what delivers the strong and perpetually growing free cash flow.
And that top-notch balance sheet, with that $12.6 billion in maneuvering room, it gives them the ultimate trump card to ensure they hit those ambitious targets, even if organic growth slows down for a bit.
Precisely. That enormous financial flexibility means they can capitalize immediately on any future acquisition opportunity, perhaps in, spirits mixers, energy drinks, or functional beverages, that arises.
So they can just buy growth.
This ability to buy growth when they need it further enhances their already healthy growth rates, ensuring they consistently achieve that 7 to 9% EPS goal that underpins the dividend increases.
So if we look back at the 63-year streak, the path to 70 years seems incredibly well paved. It seems almost guaranteed by this financial engineering.
It does. The combination of durable cash flows from that massive global beverage portfolio and the fortified balance sheet, it puts Coca-Cola in an excellent position to outlast the next major economic shock.
And reach that milestone.
And reach the rare milestone of a dividend septuagenarian within the next 7 years. It is a textbook example of transforming a legacy company through brilliant strategic financial planning.
So what does this all mean for you?
Well, I think the takeaway from the Coca-Cola endurance story is understanding how a company can strategically restructure its foundational business model. They converted these asset-heavy activities like managing bottling plants, which just drained capital, into pure cash flow and balance sheet strength. This transition provided that unprecedented stability and flexibility needed to weather market volatility and perpetually increase payouts.
It's a masterclass, really. A masterclass in shifting from an industrial operational model to a streamlined brand and concentrate ownership model.
Absolutely. But let's leave you with this final provocative thought that kind of builds on everything we've covered today. We established that the company has the capacity to take on $12.6 billion in additional debt. If the key strategy is to supplement organic growth with acquisitions, we have to wonder, what level of transformative deal are they waiting for?
Good question.
Are they planning an acquisition that fundamentally shifts their category dominance? Perhaps a major player in the coffee market or a non-traditional functional beverage company that requires leveraging a large portion of that war chest. They are built to buy growth, and the size of their financial flexibility suggests the next purchase could be historic in scale. All of it designed to ensure they hit those 7 to 9% annual EPS goals for the next decade.